A 401k can be Roth. That one sentence exposes the biggest problem with the question, should I use a 401k or a Roth IRA? Those aren't clean opposites. A 401k tells you where the account comes from, your workplace. Roth tells you when the income tax is paid, now instead of later. Many workplace plans let you choose a traditional 401k, a Roth 401k, or a mix of both. And an IRA can be traditional or Roth too. So the real decision is not one account versus another. It is two decisions stacked together. First, which account should receive the next dollar? Then, should that dollar be taxed now or taxed in retirement? Once we separate those questions, the math becomes much clearer. And the answer is not always Roth. It is not always the 401k either. But there is an order that works surprisingly well for a lot of people. Start with the employer match. Imagine Maya earns $60,000. Her company matches $1 for every dollar she contributes, up to 5% of her pay. 5% of $60,000 is $3,000. If Maya contributes $3,000, the company adds another $3,000. That match is not a tiny perk. It is part of her compensation. And if that $3,000 annual match continued for 30 years and earned an illustrative 7% a year, the match by itself would grow to roughly $283,000 before tax. That is not a forecast. Returns will vary, the match formula can change, and Maya may not stay at the same employer. Vesting matters too. The Labor Department says workers always own their own contributions, but employer money may vest over time under the plan's rules. Still, the principle is strong. Do not give up a substantial employer match while trying to optimize a smaller difference somewhere else. Read the plan, know the vesting schedule, and capture the full match if your budget allows. If this was helpful, subscribe for more practical videos about personal and family finance, and send this one to someone who might find it useful too. That handles the first dollars. The next dollars are where the real math begins. Most comparisons put $7,500 into a traditional account and $7,500 into a Roth account. Then they point out that the Roth balance can come out tax-free if the distribution is qualified. That sounds decisive, but it is not a fair comparison. A traditional contribution is made before federal income tax. A Roth contribution is made after that income tax. So the same number of dollars does not create the same cost in your paycheck. Suppose Jordan has $7,500 of take-home money available for retirement, and Jordan's current marginal federal income tax rate is 22%. We will ignore state taxes and several other complications for the moment so the core equation is easy to see. Jordan can put the full $7,500 into a Roth account. But how much could Jordan put into a traditional account for the same hit to take-home pay? Divide $7,500 by 1 minus 22%. The answer is $9,615.38. Why? Because a 22% tax on $9,615.38 is $2,115.38. Subtract that tax savings from the traditional contribution, and the take-home cost is $7,500. Now, let both amounts grow for 30 years at an illustrative 7% annual return with no fees. The Roth amount grows to about $57,092. The larger traditional amount grows to about $73,195 before tax. If Jordan pays exactly 22% tax on that traditional money in retirement, what remains? About $57,092, the same as the Roth. That is the central equation. If the tax rate is the same going in and coming out, and returns and costs are the same, traditional and Roth produce the same spendable result when you compare equal economic contributions. Roth does not create an extra layer of compounding. Traditional does not create free money through the deduction. One account pays the tax before the money compounds, the other lets the tax money compound too, then collects the same percentage at the end. So what breaks the tie? The tax rate difference. Keep the same example, but assume Jordan's relevant tax rate on the traditional withdrawal is 12% instead of 22%. The traditional account leaves roughly $64,411 after tax. The Roth still leaves about $57,092. Traditional wins because Jordan deducted the contribution at 22% and paid tax later at 12%. Now move the retirement rate to 32%. The traditional account leaves roughly $49,772. The Roth still leaves about $57,092. Roth wins because Jordan prepaid tax at 22% and avoided a 32% tax later. This is why Roth is always better when you're young is incomplete. A young worker often has a lower income and a lower marginal rate, which can make Roth attractive. But age itself is not the deciding variable. The important comparison is the tax rate avoided today versus the tax rate that would apply to those dollars when withdrawn. And that future rate is not simply your top bracket in retirement. Traditional withdrawals may fill several tax brackets: Social Security, pensions, other investments, deductions, state taxes, and Medicare premium rules can all affect the real marginal cost of another dollar of retirement income. Future tax law can change. A person who retires before claiming Social Security may even have low-income years that create opportunities to withdraw or convert traditional money at relatively low rates. No one can know all of that 30 years in advance. The point is not to pretend that we can. The point is to stop using the wrong equation. Use a range. Ask what happens if your future rate is lower, similar, or higher than today's rate. If traditional wins across most reasonable scenarios, that is useful. If Roth wins across most of them, that is useful too. If the result is close, owning some of each tax treatment can reduce the risk of making one giant bet on future tax policy. But taxes are only half the original question. We still have to decide between the workplace account and the individual account. Start with contribution room. For 2026, the Internal Revenue Service says an employee under age 50 can defer as much as $24,500 into most 401k plans. The combined limit across traditional and Roth IRAs is $7,500. Combined means combined. You do not get $7,500 for a traditional IRA and another $7,500 for a Roth IRA. For someone under 50, those accounts share the same $7,500 limit in 2026. That makes the 401k limit $17,000 larger, or a little more than 3 times the IRA limit. Suppose Sam wants to save $20,000 this year. A Roth IRA alone cannot hold it. The workplace plan is not just a convenient option, it is where most of the tax-advantaged capacity exists, and direct Roth IRA eligibility can shrink at higher incomes. For 2026, the direct contribution phase-out runs from modified adjusted gross income of $153,000 to $168,000 for single filers and heads of household. For married couples filing jointly, it runs from $242,000 to $252,000. Those thresholds do not make a high earner's workplace Roth contribution disappear in the same way. So someone who likes Roth treatment but earns too much for a direct Roth IRA may still have a Roth option inside the 401k if the employer offers it. Capacity favors the 401k, but account quality can favor either side. A workplace plan gives you a selected investment menu. That can be excellent: low-cost index funds, institutional share classes, a good target date series, and administrative costs partly paid by the employer. Or it can be disappointing: high expense ratios, separate record-keeping charges, and limited choices. An IRA at a low-cost provider can offer a much broader menu and more control. But an IRA is not automatically cheap. The investments and providers still matter. A person can fill an IRA with high-cost funds, trading expenses, or inappropriate products just as easily as they can choose a poor fund in a workplace plan. The right move is to compare actual costs, not reputations. The Labor Department gives a powerful illustration. Start with $25,000, leave it invested for 35 years, and assume a 7% gross return with no new contributions. If fees reduce the return by half of 1 percentage point, the account grows to about $227,000. If fees reduce it by 1.5 percentage points, it grows to only about $163,000. That 1 percentage point fee difference cuts the ending balance by 28% in the department's example. So after the match, a low-cost IRA can make sense when the workplace plan is expensive. But if the 401k offers excellent low-cost funds, payroll automation, and no meaningful extra charge, the simplistic IRA always has better investments rule can fail. Then there is flexibility. Regular contributions to a Roth IRA have a useful feature. Under the Roth IRA ordering rules, regular contribution dollars generally come out before conversions and earnings, and a return of those regular contributions is not included in gross income. That makes Roth IRA contribution basis more accessible than many people realize. But be precise. Roth earnings are different. For earnings to come out tax-free as part of a qualified Roth IRA distribution, the 5-year rule and an eligible event, such as reaching age 59 and a half, generally must be satisfied. Conversions have their own rules too, and accessible does not mean disposable. Every dollar removed from a Roth IRA loses future tax-free space that can be difficult or impossible to replace. A retirement account should not be the first emergency fund just because the tax code allows access to part of it. Workplace plans have their own access and protection features, which vary by plan and circumstance. Some allow loans. Distribution choices may depend on whether you still work there. The plan document matters. The clean takeaway is that a Roth IRA usually gives the owner more direct control, while a 401k offers payroll integration, much greater contribution capacity, and possibly employer money. Now we can build the order of operations. Step 1. Capture the full employer match you expect to keep under the vesting rules. That is usually the strongest first use of a retirement dollar. Step 2. Choose the tax treatment. Compare today's marginal income tax benefit with a reasonable range of tax rates on future withdrawals. Use equal take-home cost. If today's rate looks unusually high compared with the likely future range, traditional becomes more attractive. If today's rate looks unusually low, Roth becomes more attractive. If the answer is close, consider splitting contributions. Step 3. Compare the real account quality. Look at the plan's expense ratios, administrative charges, diversified fund options, and any employer-paid costs. Compare those with the IRA you would actually open, not an imaginary perfect IRA. Step 4. Use the capacity you need. In 2026, an IRA gives someone under 50 $7,500 of combined room. A 401k gives $24,500 of employee deferral room. If your savings goal exceeds the IRA limit, the plan becomes essential. Step 5. Use both if that is where the sequence leads. Maya might contribute 5% to the 401k to capture the entire match. Then she might fund a low-cost Roth IRA because she is currently in a relatively low tax bracket and values the control. After the IRA is full, she can return to the 401k and raise her contribution. Jordan, in a high-earning year, might choose traditional 401k contributions for the current tax deduction while keeping an existing Roth IRA invested for tax diversification. Sam might prefer Roth treatment but need to save $20,000. Sam could use a Roth 401k if the plan offers it because the Roth IRA cannot provide enough room. Same title, 3 different rational answers. There are also cases where a traditional IRA contribution is not deductible because the saver is covered by a workplace plan and income falls above the applicable deduction range. That non-deductible IRA contribution is not the same deal as a pre-tax 401k contribution. It introduces basis tracking and can complicate later conversions. The tax label must match the actual tax result. The good news is that you do not need a perfect 30-year tax forecast to make a strong decision today. You need 5 pieces of information: your full employer match formula, your current marginal income tax rate, the actual costs and investments inside the plan, your Roth IRA eligibility, and the total amount you want to save this year. Write those 5 things down. They will answer more than any slogan about Roth being good or a 401k being boring. And revisit the decision when your life changes. A promotion may make traditional contributions more valuable. A lower income year may make Roth contributions or conversions more attractive. A new employer may offer a better plan. Moving to a different state can change the tax comparison. Retirement saving is not one permanent vote. So 401k or Roth IRA? First, take the full match. Then compare traditional and Roth fairly, using the same take-home cost and a range of future tax rates. After that, compare the real fees, investment choices, access rules, and contribution capacity. In many cases, the most sensible answer is not one account. It is both, in the right order. The real math does not crown a universal winner. It tells you what each dollar is supposed to accomplish. Do not choose the prettier label. Give each retirement dollar a job.